Welcome to enrichminds.com and to our session on ETFs or exchange traded funds. ETF stands for exchange traded funds. Today we shall learn what ETFs are and how they can be a useful addition to your investment portfolio, as well as how they differ from mutual funds. Exchange traded funds, or ETFs, are investment vehicles very similar to mutual funds. Like mutual funds, ETFs are professionally managed baskets of investments that pool together many investors' money. Like mutual funds, ETFs can be great tools for putting together a broad, well-diversified portfolio. But unlike mutual funds that do not trade on an exchange, ETFs are directly themselves traded on an exchange. You can buy and sell ETF shares directly in the open market. That is the biggest respect in which an ETF differs from a mutual fund. Mutual funds are traded only once a day at the end of the market trading day. ETFs and mutual funds are very similar, but they are distinct asset classes. ETFs are a recent innovation and improvement on mutual funds. There are some key differences between the two. Exchange-traded funds are a twist on the mutual fund. These ever more popular investment vehicles pool investors' money and employ strategies similar to mutual funds, but they are structured as investment trusts that are traded on stock exchanges and have the added benefits of the features of stocks. For example, ETFs can be bought and sold at any point throughout the trading day. ETFs can also be sold short or purchased on margin. ETFs also typically carry lower fees than the equivalent mutual fund. Many ETFs also benefit from active options markets, where investors can hedge or leverage their positions. ETFs also enjoy tax advantages over mutual funds. Compared to mutual funds, ETFs tend to be more cost-effective and more liquid. The popularity of ETFs speaks to their versatility and convenience, and ETFs are taking business away from mutual funds. Over the last 10 years, the growth in assets invested in ETFs has been impressive, and most of that growth has come at the expense of mutual funds. Investors are increasingly opting for ETFs instead of mutual funds. ETFs have experienced very rapid growth over the last decade. In 2011, total cash invested in ETFs was only $1.3 trillion. It crossed $9.9 trillion in 2021. Let's understand the reasons why ETFs are gaining such rapid popularity. ETFs have become incredibly popular in recent years for a few reasons. First, index investing is popular. There's good evidence to show that investors on average do better with index funds, which aim only to match the market's returns, than they do with actively managed funds, which aim to beat the market's returns. Second, fees can be even lower than with mutual funds. Although you can buy index mutual funds, index ETFs can have even lower fees, and higher fees equal lower returns. Third, low initial investment. You can start investing in an ETF for the price of just one share, whereas mutual funds can require minimum initial investments in the thousands of dollars. ETFs trade like shares on an exchange, unlike mutual funds that are traded only once at the end of each day depending on the NAV or net asset value. ETFs trade just like shares, and they can be purchased or sold anytime when the markets are open, and hence they tend to have greater liquidity than mutual funds. And fourth, you can invest in almost anything with ETFs. Just as with mutual funds, ETFs can hold traditional stocks and bonds. But you can also use them to invest in things that are further afield. For example, there are ETFs that hold physical gold, that track the day-to-day movements of oil prices, and that invest exclusively in biotech stocks. ETFs can also be good tools to help investors fill a portfolio niche or reflect a special interest. Various types of ETFs are available to investors that can be used for income generation, speculation, and price increases, and to hedge or partly offset risk in an investor's portfolio. ETFs are generally characterized as either passive or actively managed. Passive ETFs aim to replicate the performance of a broader index, either a diversified index such as the S&P 500 or a more specific targeted sector or trend. An example of the latter category is gold mining stocks. As of February 18, 2022, there were approximately 8 ETFs which focus on companies engaged in gold mining, excluding inverse, leveraged, and funds with low assets under management. Actively managed ETFs typically do not target an index of securities, but rather have portfolio managers making decisions about which securities to include in the portfolio. These funds have benefits over passive ETFs, but tend to be more expensive to investors. We explore actively managed ETFs below. Bond ETFs are used to provide regular income to investors. Their income distribution depends on the performance of underlying bonds. They might include government bonds, corporate bonds, and state and local bonds, called municipal bonds. Unlike their underlying instruments, bond ETFs do not have a maturity date. They generally trade at a premium or discount from the actual bond price. Stock or equity ETFs comprise a basket of stocks to track a single industry or sector. For example, a stock ETF might track automotive or foreign stocks. The aim is to provide diversified exposure to a single industry, one that includes high performers and new entrants with potential for growth. Unlike stock mutual funds, stock ETFs have lower fees and do not involve actual ownership of securities. Industry or sector ETFs are funds that focus on a specific sector or industry. For example, an energy sector ETF will include companies operating in that sector. The idea behind industry ETFs is to gain exposure to the upside of that specific industry by tracking the performance of companies operating in that sector. One example is the technology sector, which has witnessed an influx of funds in recent years. At the same time, the downside of volatile stock performance is also curtailed in an ETF because they do not involve direct ownership of securities. Industry ETFs are also used to rotate in and out of sectors during economic cycles. Commodity ETFs. As their name indicates, commodity ETFs invest in commodities, including crude oil or gold. Commodity ETFs provide several benefits. First, they diversify a portfolio, making it easier to hedge downturns. For example, commodity ETFs can provide a cushion during a slump in the stock market. Second, holding shares in a commodity ETF is cheaper than physical possession of the commodity. This is because the former does not involve insurance and storage costs. Currency ETFs are pooled investment vehicles that track the performance of currency pairs, consisting of domestic and foreign currencies. Currency ETFs serve multiple purposes. They can be used to speculate on the prices of currencies based on political and economic developments for a country. They are also used to diversify a portfolio or as a hedge against volatility in forex markets by importers and exporters. Some of them are also used to hedge against the threat of inflation. There's even an ETF option for Bitcoin. Inverse ETFs attempt to earn gains from stock declines by shorting stocks. Shorting is selling a stock, expecting a decline in value, and repurchasing it at a later date at a lower price. An inverse ETF uses derivatives to short a stock. Essentially, they are bets that the market will decline. When the market declines, an inverse ETF increases by a proportionate amount. Investors should be aware that many inverse ETFs are exchange-traded notes, or ETNs, and not true ETFs. An ETN is a bond but trades like a stock and is backed by an issuer such as a bank. Be sure to check with your broker to determine if an ETN is a good fit for your portfolio. A leveraged ETF seeks to return some multiples, for example 2 times or 3 times, on the return of the underlying investments. For instance, if the S&P 500 rises 1%, a 2 times leveraged S&P 500 ETF will return 2%. And if the index falls by 1%, the ETF would lose 2%. These products use derivatives such as options or futures contracts to leverage their returns. There are also leveraged inverse ETFs, which seek an inverse multiplied return. How do you begin investing in ETFs? With a multiplicity of platforms available to traders, investing in ETFs has become fairly easy. Follow these steps to begin investing in ETFs. First, find an investing platform. ETFs are available on most online investing platforms, retirement account provider sites, and investing apps like Robinhood. Most of these platforms offer commission-free trading, meaning that you don't have to pay fees to the platform providers to buy or sell ETFs. However, a commission-free purchase or sale does not mean that the ETF provider will also provide access to their product without associated costs. Some areas in which platform services can distinguish their services from others are convenience, services, and product variety. For example, smartphone investing apps enable ETF share purchasing at the tap of a button. Second, research ETFs. The second and most important step in ETF investing involves researching them. There are a wide variety of ETFs available in the markets today. One thing to remember during the research process is that ETFs are unlike individual securities such as stocks or bonds. You will need to consider the whole picture in terms of sector or industry when you commit to an ETF. Here are some questions you might want to consider during the research process. What is your time frame for investing? Are you investing for income or growth? Are there particular sectors or financial instruments that excite you? Third, consider a trading strategy. If you are a beginning investor in ETFs, dollar cost averaging or spreading out your investment costs over a period of time is a good trading strategy. This is because it smooths out returns over a period of time and ensures a disciplined, as opposed to a haphazard or volatile, approach to investing. It also helps beginning investors learn more about the nuances of ETF investing. When they become more comfortable with trading, investors can move out to more sophisticated strategies like swing trading and sector rotation. Let's look at a few fun facts about ETFs. The SPDR or SPDR Gold Shares ETF holds about 70,000 bars of gold, each weighing 400 ounces, in an HSBC vault in London. Once a year, it hires a firm to count every single bar in the vault to make sure they're all there. Funds invested in ETFs in the U.S. will cross $12 trillion in 2023. The world of ETFs can get pretty strange. There is an obesity ETF, the Global X Millennials Thematic ETF, and the Health Shares Dermatology and Wound Care ETF. Let's now watch a short video on ETFs courtesy of Investopedia.
An exchange-traded fund, or ETF, is a basket of securities that trade on an exchange, just like a stock does. An ETF is a marketable security, meaning it has an associated price that allows it to be easily bought and sold. ETFs can contain many types of investments, including stocks, commodities, bonds, or a mixture of investment types. There are various types of ETFs available to investors. Let's explore some popular options on the market today. Stock ETFs comprise a selection of stocks to track a single industry or sector. For example, a stock ETF might track automotive or foreign stocks. Bond ETFs invest in various fixed income securities, like corporate bonds or treasuries. Unlike bonds themselves, bond ETFs don't have a maturity date. Industry or sector ETFs are funds that focus on a specific sector or industry. For instance, an energy sector ETF will include companies operating in that sector, like natural gas, oil, and renewable energy companies. Commodity ETFs invest in commodities, including crude oil or gold. And holding shares in a commodity ETF is cheaper than physical possession of that commodity. Currency ETFs track the relative value of a currency or a basket of currencies, including foreign currencies. There's even an ETF option for Bitcoin. Inverse ETFs attempt to earn gains from stock declines by shorting stocks. Essentially, inverse ETFs are bets that the market will decline. When the market declines, an inverse ETF increases by a proportionate amount. While there are many types to choose from, all ETFs offer similar benefits: access to a wide variety of stocks, lower expense ratios, fewer broker commissions, and risk that is managed through a diverse portfolio.
So, in summary then, our main takeaways from our session today are: first, ETFs are very similar to mutual funds and are a relatively recent innovation on mutual funds. They offer certain advantages over mutual funds and hence are gaining in popularity. And second, given the apparent advantages of ETF investing, there has recently been significant cash flowing into ETFs at the expense of mutual funds. Thank you for your time, and until next time then, stay enriched and strong.